So we can have it be very educational focused, we can have it be very just networking focused, we can have it be very deal specific. So I've seen basically meetups where people just come up to the mic and say, I'm working on this deal, this is what I need, this is what I'm looking for. And then after 5-10 people have done that, then we do some networking, and people are obviously saying, oh, actually I know somebody that can do that, or I'm the person that has this thing that you need, et cetera, et cetera. So there's a bunch of cool different things that we can do. And so we'll kind of get into some questions, and we'll probably send out some polls and some things just to get a better sense of what you guys want to do. I had a really good conversation with somebody from Edmonton that's doing the same type of thing. He's running a meetup up there. And so he said what's worked really well for them, in order to get the best numbers, is they'll have between 2 and 3 speakers. And the benefit, of course, is that if you're interested in at least one speaker, you're probably going to come. And if you have 2 or 3, then there's a higher probability that people are interested in these other different topics. So that's something I'm like, well, that's pretty cool. If we can get 70 to 100 people out to these types of events, first of all, we got to find a bigger venue, obviously. We got to find some sponsors and a few other things. So that's all the things that we want to kind of investigate, talk about, and discuss. So what I thought I would do tonight is give you a presentation. So what he recommended, he said you want to have about 45 minutes of education, 30 to 45 minutes. And so if there's 3 guests, they would each get about 15 minutes, then do about 15-20 minutes of Q&A with the panel, with the speakers, and then about a half hour of networking. I thought that's a pretty cool event. That's something that I would want to show up at and participate in for sure. Welcome, Ahmed. We're going to have you guys introduce yourselves just because you got here late. So just your name, where you're from, and what you do.
Okay. My name is Zanfar Ahmed. I'm from Calgary, of course, and I'm a technology professional.
Excellent. Welcome.
Hi everyone, my name is Wade. I'm back in Calgary, actually from BC. I'm a home builder here in Western Canada, and in the process of moving my business down to the US.
Very cool. Do you know where you want to go? Oh, thanks.
Right now we're in Orlando doing a house tours, so
Cool.
that's our target market.
How's the market down there?
It's hot right now.
Yeah.
Love it. Oh, we got another one. We're just doing introductions. Since you showed up late, you get to introduce yourself. So.
Hi. Starts with me?
Yeah, so your name, where you're from, and what you do.
Yep, so name is Haji Ali. I'm a realtor here in Calgary, and I live in Edmonton.
Perfect.
Originally from India.
Welcome.
Thank you.
The ever endless late people keep coming on, but that's all right. We won't let Nathan introduce himself. We're just going to jump in. So I want to, where did we go? There we go. So this is a topic that I've shared with a number of real estate groups. I thought since this is what I do and it's really easy to find me as a speaker, I thought I could give a quick presentation on what it is that I do, and then that way you guys know going forward if there's some way that I can help you, or you guys can, as you're chatting and networking with other people, you'll find out everybody needs capital. So it's part of the real estate game. And I'm not the only player in town, of course, but I've been lucky enough to have been in this industry for just over 18 years now. So I know a few things about who the players are, how to get deals done, how to raise capital, how to put together a capital stack, those types of things. So what I was hoping to do today is just help you guys scale your real estate portfolios with private and creative financing. And we also will talk about a few other business models, fix and flips, a few other things like that. So let's jump into it. So there's this house that was in Edgemont. You guys might recognize that style of home. It actually looked pretty decent, but inside it was totally trashed. It was, mom and dad had been living there forever, never renovated, never updated it, full of stuff. It was really bad. Unfortunately, I just don't have an interior photo. So, but we helped finance a fix and flipper, and he fixed it up. And this is what it looks like now on the inside. So went in and did a full renovation, whole new kitchen, relaid out the kitchen. I don't think, no, he didn't change the stairs in this one. New bath, new all the fun stuff. This was a pretty interesting tub to get up in that bathroom as well. And because I just work in finance, I get to look at spreadsheets all day and emails. And so when I get to look at the finished product of what somebody actually went and did with their hands, I'm always like, oh, this is cool, right? I don't get to do that on a day-to-day basis. Like I get to the end of the day, I'm like, yeah, I made some phone calls. It was great, right? Like, so when I get to see photos like this, I'm like, yeah, this is cool. This is neat stuff. So I envy the guys that are out there doing this with their hands and actually creating. It's pretty awesome opportunity. So this is another building we actually bought. This is a 12-unit building in Regina, Saskatchewan. And as you can tell, it got totally boarded up. It was in the roughest part of Regina, if you guys know Regina at all. The roughest part of Regina is worse than the roughest part of Calgary, which is strange because there's only like 200,000 people there. But it's rough. And so the city came in and they said there's too much crime, there's too much drug dealing going on, whatever. We're just going to actually shut the building down. So we bought this from a very motivated seller that was like, I don't know what to do with this building. And we were able to turn it around. So about 12 to 18 months later, this is what it looked like. And this was all made possible, of course, through private financing. So I'll give you a little bit of background about me. That's me. I'm one of 7 kids. I'm still a goofball. That's my mom. I'll tell you a little bit about her. And that's my crazy family. So my mom, let me go back one here. She was this awesome entrepreneur that was obviously trying to help get 7 kids through life and through school and through all these different things, right? And so mom would do whatever she could to make sure that we had enough food, make sure we had enough clothes and new shoes to go back to school. And so she was always doing some sort of a side gig. Dad was working. We were never poor, we never wanted, but we definitely didn't have all the stuff that I saw all my friends doing and things like that. But I got a lot of hand-me-downs. I'll give you an example. My sister and I, we went to a new school. She's 2 years older than me, and it's middle school. And that year, we couldn't afford enough clothes, so mom bought her a pair of jeans and me a pair of jeans, and then every day we would switch. So she got the black ones, I got the blue ones, and then the next day we would switch, so we weren't wearing the same pair of jeans every day. So, but mom would do all these cool things, so she is like, well, I want to can fruit, but it's so expensive to buy fruit at the grocery store. So she started buying fruit in bulk from BC. And then she's like, oh, these other people want some fruit, and these other people want some fruit. So eventually she was selling BC fruit out of our garage, and eventually we had full semi-trucks coming and unloading. We would unload for hours, these big boxes of 40 pounds of fruit, and mom would sell the fruit from the garage to help, again, pay for all these things. Anyway, so mom was actually asked to throw a family reunion for her big extended family. She's one of 8 kids. And she went to the library, was trying to research, how do you throw a good family reunion? She couldn't find a book on it. And so after she did the reunion, her and her sister decided, well, we're going to write a book about this to show people how to do it so that they have a resource. And so they spent all this time and effort and energy on writing this book. And then she couldn't find a publisher. She went around to all these different publishers, and everyone's like, it's kind of a niche topic. It's probably not going to sell that much. And so, of course, my mom being the never giving up entrepreneur, she said, well, fine, then I'm just going to start my own publishing company. And so she called it Lions Den Publishing. And so in honor of mom, we named our company Lions Den Capital. Unfortunately, she passed away in 2004 from cancer, but we remember her often with all of the things that we implement into our business with that entrepreneurial spirit. So we're a boutique private lender. We've done over 400 million in transactions, both private and creative. We focus in Alberta, BC, and Saskatchewan. And we help people with real estate purchases with as little as $20,000 down. And we can get into that a little bit further down the line, but we basically help provide private financing solutions. We're a solutions-based lender, and we want to help you guys grow your real estate business, whatever that looks like. So I want to jump into a little bit. We're going to dig deep into private lending. So for those of you that know all this will be just like a quick review or a reminder. Go ahead and get out your phone and do what you need to do. But for some of you that don't know what private lending is, when I got into private lending, I didn't really know what private lending was. I thought it was like this mystical thing of like these people with millions of dollars that had private money and private funds and all these private things. But we'll go through a little bit about what that is and what that isn't. So as you guys know, there's lots of places you can get capital for your real estate transactions, right? So we got banks and credit unions. We've got trust companies. Does anybody know what a MIC is? It's an acronym for something. It stands for a Mortgage Investment Corporation. So you guys, if you've ever heard of, basically they're large funds that do private lending. And so they pool people's capital together and they lend it out. And usually mix will range from about 50 million under management upwards to $1 billion under management. So they're big players. Of course, we like sellers that will provide private financing, any VTBs. The Bank of Mom and Dad, which is super popular these days. If anybody knows our mortgage broker, you've seen a lot of transactions get completed with the Bank of Mom and Dad. And then sometimes it's just a rich, wealthy individual that has some capital. And then also there's lots of just other random people that have capital. So it might be a dentist, it might be an engineer, it might be a police officer. Actually just had a conversation with a police officer from Saskatchewan yesterday, and he has some money that he wants to lend out on private loans. So in Canada and in the US, we generally pool these groups of lenders into 3 different groups. So we call them A lenders, which would be the main banks and credit unions. This is where you're going to get your cheapest financing. And so if you ever have an opportunity to borrow from a bank, this is where you want to get funds from, because that's going to be your cheapest source of capital, right? But of course, the banks have very strict rules and guidelines, and you have to fit into their little itty bitty box. And if you don't qualify. Next, we have our B lenders. So this is basically they say we'll lend outside of the A box. The other names they like to give themselves are Alt A, or what's the other one I'm thinking? Subprime is the other one that they get called in the US a lot. And they're a little bit more flexible, but of course they cost a little bit more because they're taking a little bit more risk. And then our C lenders, or the other group of lenders, which is where we have all the private lenders. This is the area that the private lending falls into. And so that again might be the private individuals, hard money lenders. The US uses hard money lenders in a really unique way. I still don't know if I fully understand it, and I don't think that they understand it either, but and then other groups and syndications and other private lenders like Lionstone Capital. So there's lots of myths that go around with private lenders. So one of the ones is that only people with bad credit will use private lenders, which just simply isn't the case. So I'll give you an example, is if you're doing a buy, fix, and sell, there's no bank that wants to lend you money for 4 months, right? Is there any banks that you know of that are like, sign me up for that 4-month deal where you're gonna borrow money, you're gonna fix up the house for 4 months, and then you're gonna sell it, and you're gonna pay me all my money back? No, banks wanna lend for 25 years, right? So even people with good credit that wanna borrow for a short period of time are gonna use private lenders. All private financing is very expensive. I would say right now is actually one of the cheapest rates that we've seen for first mortgages. You can get some first mortgages from private lenders with as low as in the 6s right now for an interest rate, which is pretty insane. So there's a lot of capital pouring into the market right now. And so of course, as the supply of capital increases, the price of that capital decreases. So we're actually seeing really low interest rates from some of the lenders that have just too much capital on the books. Private lenders are predatory lenders. So if you've ever heard of like a loan shark, or that's where some people kind of mix the two. They're like, yeah, I think if I borrow from you and I don't pay you back, I get broken legs or something. Is that how this works? No, that's not quite how it works. So, and then private lenders will only finance high ratio mortgages. This is a question I get every now and then. They're like, hey, I want to buy this house. I've got 5% down. I need a private loan. I'm like, no, that's not how this works. You need a CMHC insured loan, but if you're looking for a private loan, you probably don't qualify because either your credit's banged up or you just can't prove your income, et cetera, et cetera. So generally, most private lenders are equity-based lenders. They'll lend based on the equity in the property, not put as much weight on the quality of the borrower and their credit score and their ability to prove their income, et cetera. And then, yeah, we talked about this one already, back alley, broken arm type of stuff. So stay away from those. We talked a little bit about this. So these are the common reasons why people might use private financing. Debt consolidation is a really big one. We won't get into it too much because it doesn't really apply to too much of what you guys are doing. Bridge financing is super helpful. If you guys are trying to buy one property before you sell another one, we can help to bridge the gap. Construction and development, of course. If you guys have ever tried to get a construction loan from a bank, it's even worse than getting a regular loan from a bank. So oftentimes developers and builders will turn to private financing for those deals. Renovations, buy, fix, and sells is a huge one. And then to purchase income property. So we see a lot of borrowers coming to us saying, I've got this opportunity, I want to buy this property. It's a fourplex, for example, to rent out. but I don't have enough for the down payment and I can't qualify for this and that and whatever. And so what we'll do is we'll either help them pull some equity out of their other assets and use that as the down payment, and that will often get them to the bank, or we'll do some sort of a temporary loan to give them the capital they need to close on it, and then it's actually easier to refinance it once they've gone and fixed it up and added some value to it. So then the bank looks at it and goes, oh, you've got tons of equity here, we're happy to lend to you. So I'll give you a quick example of some of the numbers. So this is for that Edgeview Road property that we saw at the beginning. So purchase price $615, motivated seller, got it for a good price. Big renovation budget, probably spent a little more than he wanted to, but that's how much went into it. Closing costs, financing fees, so total all in for $810. Was able to sell it for $1 million. He packaged it up nicely, and after realtor costs, carrying costs, he still was left with over $100,000 in profit in 6 months. So when I look at these things, I go, man, if I can help the average flipper do 2 or 3 of these a year, that's a pretty good income for the average guy. And those are all in costs, right? He's not paying guys on the side. This is. I just wanted to show you those photos again, but I'm going to skip through this. The 5 C's of traditional borrowing. If you're really interested, talk to your fellow local mortgage broker. They can teach you about that. This is kind of what I want to get into. So when when I was getting into understanding the creative finance world, the private finance world, it's hard to kind of shift your mind from the traditional way of thinking of, I want to buy a house, it's $500,000, I need to put X amount down, and then I'm going to go to the bank and get the difference and buy the house. As soon as you open your mind to other ideas and possibilities, the amount of creativity that's out there is endless. And if you guys are following Pace or following Jamil and you see some of the other techniques and stuff that they're teaching, it still boggles my mind, some of the things that they're getting done. So it's pretty cool. So let's talk about that. I want to give you guys this if you guys want it. We'll talk about that at the end. I want to jump to this. So when I look at a deal, I always picture it as a house or a triangle, right? And at the bottom is where you have the safest money, the cheapest money. It's the first mortgage. This is generally where the banks like to lend. And so you can go out and get a bank loan for as low as 4%, or you can get a private mortgage. And right now you can probably get that somewhere between 6 and 11, 12%, depending on loan to value, location, all those different things. So this is just a quick example just to show if we got a first mortgage up to 65% loan to value, we could potentially go and get a second mortgage for another 10%, and that would be priced somewhere between 9 and 16%. And then of course the most expensive money in any deal should be the equity. And why is that? Because the equity is at the top. If the market drops, guess who's going to take the hit first, right? That's you, that's the investor, that's the down payment. So if you're raising capital, generally you're going to be raising capital from investors that want a high return. And so that's going to be the most expensive money. So we want to always get this as small as possible, right? We want to get as much as we can from the cheapest amount possible. And that's generally first mortgages and generally from a bank. So if you go deep into finance, there's this fancy calculation and word that they use called WACC. They're like, what's your WACC? What's your weighted average cost of capital? I see some heads nodding. There's some people that know their WACC. They know that they're whacked. So what you want to do is you want to take into consideration both your cost of your debt and your equity. And so big companies will do this when they're deciding to build a project. They'll say, well, what is our cost of capital? And what return are we going to get on this project? And then they'll make a business decision on, is this going to make sense for us? So we can do the same thing when we look at a real estate transaction, where we can say we've got a first mortgage at 6%, we've got a second mortgage at 10%, and our equity we want to be earning at least 12%. So what is our weighted average cost of capital? And if you can do this, you should be able to analyze the deal very quickly and make a decision of, is this something that makes sense? So in this case, this weighted average cost of capital is only 8%. So if you guys know cap rates, I don't want to get too deep into heavy things here, but if you were to go and buy a building at a 9% cap rate, you would know that you'd be able to make more than your 8% on your average cost of capital, your weighted average cost of capital. Everybody following? Any questions? Good? Good. So sometimes what we find is that somebody will be, they'll have a first mortgage and they're with a bank, and they say, well, I want to pull out $150,000 to go and buy something else. It's like, okay, great, we're going to get you a second mortgage. Maybe you need the money quickly, or you don't qualify for a traditional bank loan. that'll probably cost you, let's say, 13% as an interest rate. And they go, oh, 13%, that's awful. How am I ever going to afford 13%? But if we very quickly will do a WACC calculation for them. Sorry, I jumped ahead. I got a little excited. So the next one is our weighted average cost of capital takes into account the debt and the equity. And if we're just looking at our weighted average cost of debt, our WACC-D, we can talk a little bit about what does that actually look like. Okay. So in this case, if we're just got a first mortgage, our WACC-D would just be 4.35%. We're not blending it with anything. Our equity is there on the top. And so, yeah, let me just get forward here. Yeah. So if we were to take that same first mortgage, add a second mortgage, oh, it's good I even used the right number, and at 12%, sorry, I said 13. So basically, you do this fun calculation, and our weighted average cost of debt here is only 6.9%, right? So again, we have people that go, oh, this 12%, it's so big and scary and all these different things, but if you actually blend it together with what you already have, it's not that big and scary, and we can help people realize very quickly that, hey, I can actually go and use this to leverage, take money out of this property, and go and buy something else. So in general, this is the rule, is if your cash flow is higher than your WACC-D, you can safely add private debt. If your cash flow is less, then you got to figure out some other way to do the deal. Either reduce your leverage or improve your NOI. We won't get into that because it's a little trickier. So the next question you guys are probably asking is, how do I find this private debt? How do I find these people? So we're one. Seller financing is by far the best option, right? So if you guys have been following PACE, again, you know that seller financing can be the most creative. There's nobody better set up on the planet to lend on your property that you're buying than the seller. They know the property. They're fully exposed, right? So they currently own this property, right? So let's just say we've got a property here worth $500,000, and let's say they owe nothing on it. They're here. This is all equity. Right? If the market comes down, guess what they're going to lose? They're going to lose money. They're going to lose equity. They're already fully exposed. So when you come to them and say, hey, I'm going to give you $50K down and you're going to carry $450 for me, they should be laughing. They're like, this is great. I'm not at the top of the triangle anymore. This is amazing. And if you build in there some tax advantages for carrying financing, you build in there that they're going to be earning interest over time, you can walk them through and say, like, if I'm paying this to you over the next 10 years, I'm actually going to be paying you $500,000 plus another, let's call it $50,000 in interest. I'm actually buying the property from you for $550,000. So that's a pretty good conversation to have with sellers. In Canada, just so you guys are aware, I'm not an accountant. Next time when Ear Finale is here, my accountant that I always ask these questions to, when a seller is carrying financing, we don't have the advantages like they do in the US. So in the US, you can carry financing for 20, 30, 50 years. And you only pay capital gains on the money that you receive. In Canada, there's Irf. I was just talking about you. Awesome. We got a good question for you. I just want to confirm. So the last time I was reviewing these rules is when you're a seller financing a property in Canada, that you can defer paying taxes of up to 20% per year on the sale price.
Yeah, so in Canada, you basically get whatever money you're collecting, you have to report that as a gain, but if you spread out your collections, you can take up to 5 years.
Awesome.
20% per
Yeah,
year.
20% per year. Cool. So there's still some pretty good advantages to selling and carrying financing. One of the simplest ways for a lot of sellers to do it is actually just break the sale up over 2 years, right? So if they sell December 15th and you pay them a chunk of money and then they carry financing for 6 months or 12 months, and then you pay them the balance, that's a great way for them to just actually build or put their capital gains exposure over 2 years rather than just one big lump sum in 1 year where they get hit with this huge tax bill. So that's a really simple one, just over 2 years, but you can do it up to 5 years in Canada and take advantage of those. So here's a few other places that you can find financing, of course. So mortgage brokers, they're usually quite good resources, full of ideas of, you can talk to this person, you can talk to this person, you can talk to these mix. Off the top of your head, do you know how many mix you could name? At least 3 or 5? No, okay. You probably don't play in the private space very often, which is fine because there's a big need for people that know and understand the A and B space and don't deal in the private, so that's no problem. I didn't mean to put you on the spot. High net worth people. So these are the people that I love using for private capital. So, and they don't actually have to even be high net worth. They just have to have capital that they have disposable for an investment. So in Canada, most of you, I hope, know this, but you may not know, but you can lend money from your retirement accounts. So if you have money in your TFSA, if you have money in your RSP, your LIRA, your RESP, any kind of crazy, registered account that the Canadian government has provided, you can use a self-directed account to lend that money on mortgages. There's a few rules and stipulations. You can't lend to yourself. You can't lend to a family member. You have to lend within the rules and laws of the land, so you can't charge usurious rates. You go to jail for that. And sometimes the trust company, the account holder that you use to facilitate this transaction, will also have some requirements. So that might be you need an appraisal on the property, or you need to have at least one payment per year. So there's a few things that you got to meet, but they're all pretty reasonable. And for most people, I'd say that most Canadians over the age of 40 have some money stuck in some account somewhere, right? They've been part of an employer that's put money away. They've been part of a share buy plan or something. They've put some money away. They have some capital. And most of them are not super happy with the returns that they're getting, right? So this is a great conversation to be able to have with people to say, hey, I don't know what you're doing with your investments currently. And they go, I've been up in the stock market. It's been like this, and I get scared and I can't sleep. And I talked to this one lawyer. He's nearly retired now. He's like, yeah, I tried the stock market investing. He's like, I couldn't sleep for a month. I hated it. He's like, I just could not deal with the stress of the ups and downs. He's like, I just got out of that, and I'm just fully into lending on mortgages. So there's lots of people out there that want these types of returns, and you can offer it to them. We talked a little bit about vendor financing. I think we hit all those points. Deferring capital gains. This is one that we bought in Calgary here, fourplex. We got a VTB at 80% loan to value, put 20% down. The payments were very simple and straightforward. We did interest-only payments for $2,500. I think he agreed to carry for 2 years, and we sold it and profited within 9 months and got out of that without too much capital involved and with a decent profit. The cool thing is once you get into the private lending space, we can start talking about all these other fun things, and you guys have maybe heard Pace talk about some of this stuff. So agreement for sale is a big one that we use in Canada. Wrap mortgages, a little less so. Inter alia is something that we do quite a bit. Blanket mortgages, if you guys have heard of those. Postponements. Does anybody know what a postponement is? So postponement would be, what's the simplest example to use? Basically, if, let's say you bought a fourplex and you used a private mortgage for first position. And you've gone in now, you've done all the renovations, and so this is a better example. You buy a fourplex for $400,000, and you got the seller to carry $300,000 at 4%, okay? And now you go in and you do all the renos, and you've done a huge facelift on this thing. Now it's worth $800,000. If you were going to go refinance that, the first thing you would have to do is pay out the seller financing. What you could do is you could say, hey, Mr. Seller, how about I go and get a new loan, and you postpone to that new loan. And so you actually go into second position. So you don't discharge the loan, you don't pay him out, he postpones. It's a little trickier when you're dealing with a bank, but we do postponements with private loans and all different things all the time. So it's an advanced move for sure, but these are some of the cool things that you can do. Has anybody done an agreement for sale besides me?
Is that like the contract redeemed?
Yeah, very similar. Basically what it is, this is seller financing on steroids. So I'll give you an example. So because sub-2s don't work really well in Canada, does anybody know why?
Legal.
It's illegal in the US too. Well, it's not illegal, it's against contracts. Any second mortgage, just so you guys know, second mortgages are against mortgage contracts as well. Every first mortgage written in Canada says, if you put a second mortgage on this property, we can call the loan due. Guess how many loans have been called due? 0. Nobody calls a loan. Like CIBC does not want to be the guy that's foreclosing on somebody because they went and got a second mortgage when they offer second mortgages. It's ridiculous. So when somebody says it's illegal, technically they're right. It's against contract, just like speeding here is against the law. But are you going to go to jail for speeding? Not unless you're doing something stupid, right? So it's a gray area for sure. So an agreement for sale, we'll use AFS as a short form. I'll give you an example. So if, what's the best way to do this one? So if I want to buy a house and there's currently a first mortgage on it for $150,000 with the bank, okay? And Bob is here, he wants to sell me the house. He wants to take his equity, he wants to go and buy a little condo and live in and wants to downsize. But we've got this loan here that's really attractive. He got this during the end of COVID, so it's at, let's say, 3.2%. And there's 2 years left on it, right? We all know that in Canada, our terms are like 3, 5, maybe 10 years if you're lucky, right? And this is the main reason why sub-2s don't work in Canada, because our loans reset every 5 years. And so if this property is worth $500,000, we want to put as little down payment down as we can or want to, right? Obviously. So let's use a reasonable down payment. I know Pace loves to do all these deals with zero down and stuff like that, but let's do a $50,000 down payment. Okay? So this is our equity. Now, if we just simply transfer the title, Bob's going to say, well, what's going on with my mortgage? I don't really feel comfortable transferring title, et cetera, et cetera. So this is kind of how we get around the sub-2 situation. So instead of taking title and taking over the loan subject to, we're just going to do what's called an agreement for sale, which is basically just a contract that says all the different stipulations of, I'm going to buy this property for this price, $500,000. I'm going to put $50,000 down, and the seller is going to carry a total of $450,000 at, let's call it 3.5%. And I'm going to make monthly payments of, what do we say, $2,000 a month. Principal and interest payments, and I don't have all the calculations, but that's about right. Payments per month. And so what happens now is the lawyers will draft this up. You go in and sign just like you would any other closing, and you set a closing date. And on February 1st, well, we're already past February 1st, March 1st, we take possession of the property. And so $50,000 will go to the seller. The loan stays in place, and effectively, a new loan is created in second position, but it's almost like a wrap, but the structure is the agreement for sale. And so the agreement will lay out all those terms, and then it says also, he's going to say, I don't really want to deal with this mortgage after the 2 years, and so he's probably going to say, I'll do the agreement for sale term for 2 years, okay? And so at the end of 2 years, you'll basically pay out the balance owing, which will be $450 minus any principal payments that you've made over the period of time. So it's a way to do seller financing when there's an existing loan. So there's a couple key points to remember, is that Bob will keep the title, okay? So this is another great thing, is that when you talk about doing seller financing and you're only putting $50,000 down, sometimes the seller is going to go, you want the title and you only give me 10% down? It's a little scary. But if you tell Bob, look, I've got another structure that we can use where you actually keep the title. Your name's still there, right? City of Calgary is still sending you the tax notice, et cetera, et cetera. So this is an option. This is a structure that we've used numerous times when buying 4plexes, 10plexes, up to 36 units, I think was one of our biggest ones here in Western Canada. Any questions about the agreement for sale?
Promissory, the name of it, but it's essentially default on any payment. The owner of the property, of the or whatever, would actually just get their property back.
Yeah, good question. So what we do is Bob, because he's on title, we have him sign the transfer. Okay, so he's going to pre-sign the transfer, and we're going to sign a discharge. So at the time of closing, our lawyer is going to register this document on the title. So it'll just show up and it'll say a buyer's interest caveat. Okay. If you want to see what that document is, you can actually go to Land Titles, pull the document and find it if you wanted to. So it's a published public document. And what we do is we have the lawyers hold these in trust, right? And again, this is another level of trust that you give them to say, look, your lawyer can hold the discharge so that if we default, You just discharge our caveat off the property and you have the property, right? And vice versa. If he was to pass away or change his mind or something, sorry, buddy, we've already signed the transfer. Your lawyer's holding it in trust. As long as we meet our terms of the bargain and pay the $450 within the 2 years, your lawyer's going to transfer it. He's not going to lose his license over.
And if the person under the financing agreement defaults and executes that discharge, the owner of the property keeps the profits, keeps whatever had been paid.
Yeah, exactly.
So it would almost be in their interest
To have them default?
it's like,
Potentially. But most people, they structure a deal because they want to sell it.
right,
Yeah.
they want to sell it, but like I think people shy away from the agreement for sale and like maybe don't know this.
Mm-hmm. Yeah. What's really interesting is that they actually teach in our mortgage documents and in our mortgage training, I don't know if you remember, is they actually talk about an agreement for sale. But if you ask, I'd say 80% of the real estate lawyers, they don't know anything about an agreement for sale. They'd be like, oh, I think that's scammy. So you definitely have to find the right people that know about it. And but it's in our laws. It's in the real estate manuals. It's there. So it's something I've used numerous times. Any other questions about agreement for sales before we go on? I don't want you guys to get too tired and sleepy here. Equity takeouts, we've talked about these. These are pretty simple. You want to just pull some money out of your house. You've got all this equity that's built up. I think that, I don't know if you're seeing this a lot, but we've had a good run over the last, since COVID, of prices in Calgary increasing. And so you've probably got a number of people that are like, hey, I've got $100,000, $200,000, $300,000 worth of equity in my property. What could I do with that? Can I pull it out and pay off some student loans or consolidate some other debts? Can I pull it out and buy another property or maybe a cabin or a big fancy trailer or something ridiculous? So this is a pretty popular thing. We see quite a bit of equity takeouts. And that's the presentation, guys. Questions?
Are you able to touch on the taxation advantage for a seller? In this case, let's say the seller take $50,000
Mhm.
upfront and still holding the title. So how is the taxes being considered in this case?
I would refer to my tax professional.
Yeah, so basically on that deal, again, you've got that capital gain deferral that you can take advantage of, right? So especially if you play with the timings of things, so if it's a corporation, year ends can be throughout the year, or if it's an individual as a person, like January to December, if you're buying a property from them even in July and the deal closes, let's say it's a 1-year period and it closes in the following year, they can basically take their capital gain and split that over 2 years. So for somebody who's got a massive capital gain on the property, it could be a big advantage because you can keep them in a lower tax bracket and they could save easily 5 to 10% on their tax bill at the end of the day.
So if the structure is over 5 years, so does it mean that they can spread it over
5 years, yeah. So what happens is, so let's just say the capital gain's $100,000. Based on how you're paying them, if you're paying them over 5 years equal payments, they could take as little as $20,000 of the capital gain in each of the 5 years. But it has to be a minimum. So if your deal's over 10 years, they still have to take $20,000 per year. So that's the most you can really spread it out.
So, sorry, just a minute, just on this, but, so if I'm creating terms for an agreement for sale offer, then my terms could stretch over 10 years. It's just, they would have, like, does the deal have to close in time?
The deal doesn't have to close, because when you're doing an agreement for sale, like it depends on the situation of the client. So if they're gonna come to me and say, okay, I've done this agreement for sale, we're gonna say that the property is essentially being sold at that time period to defer the capital gain over 5 years. So that's where there's gonna be a little bit of subjectivity with that in terms of the actual timing of the close and the way the deal is. But essentially the agreement for sale, the transaction can already occur and we're gonna realize that capital gain. And so even though the agreement might be over 10 years, they can defer the capital gain over 5 years. It doesn't have to close in that time period. Because from that seller standpoint, they're gonna say the property is essentially already sold. that make sense?
In that case, how would so there is no transfer of title, right?
There's no transfer of title, but you're able to create like what's called a bare trust, for example, as well. So bare trust is saying that title is in one person's name in trust of somebody else. So you can add that component to the paperwork and things like that to make it so the CRA is at least happy on that.
Would they see as this property not being the primary residence for the seller, and then it's something else, right?
Correct.
Yeah, good questions, guys.
So I think for me, I'm trying to understand how the 5-year thing in Canada affects what we're doing in the 30-year terms over in the US.
So yeah, so the biggest benefit that I see in the US is that they don't, basically it's a very simple rule, is you pay capital gains on the amount of money that you receive in the year you receive it. It's super simple, super black and white, and it makes creating 10, 20, 30-year seller carry financing deals very simple and straightforward. So the challenge with Canada is you can only defer up to 20% of that capital gain over 5 years. So 20% per year. So you can still structure the deal longer, but the person will just have to pay the taxes within those 5 years. So the challenge with that, of course, is making sure that your terms will give them enough cash that they can pay that. Because the last thing you want to do is sell a property, only get $10,000 down, and then have to pay $30,000 to the government after year one and go, oh, this seller financing deal sucks, right? So it takes just a little bit more work to make sure that, okay, so you'll have to find out what is your capital gain? What did you pay for it? If I'm buying it for this, your exposure now is going to be this amount. And if we're deferring that over 5 years, that's going to be this type of exposure, you're going to owe this much in tax. So we want to make sure that you're at least getting that amount per year, right?
That's 20% per year of the capital.
Exactly. Yeah.
So on the same question, does the seller in this case actually have any tax advantage, or it's just a matter of it's the same amount but deferred over 5 years instead of one shot?
The advantage is your tax rates, right? So let's say, for example, somebody has a big gain, $300,000-$400,000, and they're already in a middle tax bracket. Now, all of a sudden, a big chunk of that gain is going to be paid at the highest tax rate of 48% in Alberta. If we can reduce that gain and say you're going to say it's a $500,000 gain, you're going to take $100 a year, they might not be paying 48%, they might be paying 40% per year. And so that's where you get that spread. So you get the deferral of the tax, but then that will allow you to potentially get into a lower tax rate as well overall, and then you get the savings, right?
And how would it be different from a corporation acting as a seller? Like, how would the capital gains apply?
Yeah, so you still can do the deferral. The tax rate, it gets very complicated with passive income, active income, all this kind of stuff, but let's just say your tax rate's not likely to change in the corporate scenario, but you get the deferral still. So you can defer a portion of the gain over 5 years, right?
But I think in the corporation, it's no longer a capital gains, right? It becomes a
Profit,
Depends,
Really?
like regular income.
Yeah, it's like our income versus.
It depends on the seller and what they've done with the property, right? So if I'm flipping the property, for example, and I'm the seller, and I bought the property 6 months ago, I fixed it up, and I'm flipping it to somebody, then yes, it's active income, right? Then you don't get the deferral because that's going to be active income. But if I hold the property in a corporation and it's been a rental, it still gets treated as a capital gain. So then I can get the 5-year deferral. Does that make sense?
Quick question: if you're doing a flip, so you're buying it, you're renovating it, adding units to it, or doing anything like in that sense, since you're not holding it in your name, right? The title is in the previous owner's name. Who gets the write-off and who's paying the capital gains when it sells for way more?
Good question. So the way that I understand it, and a lawyer explained it to me, is when you're doing the agreement for sale, there's 2 forms of title. So you have the legal title, so whose name is actually still on title, and then you have beneficial title. So that's the person that's taking ownership of the property, they're renting it out, they're using it for their purposes. So one of the downsides to using an agreement for sale is that the seller will continue to be able to depreciate the property over that time because he has the title. And I've seen Pace talk about this same, sounds like it works the same way in the US. And so the buyer technically wouldn't be able to have any depreciation during that time while they're using the agreement for sale.
Depreciation is one thing, but the extra expenses that you spend on a property, so say like again, 400,000 property, you put 250,000 renovation into it, now it's worth 800,000. Right, there's a profit in there, so potential, depending if you're a flipper, active income, in a corporation, active income, you also have an expense on it. How does that work if you're not the actual owner?
You would still, like, going back to what Steve's saying, the beneficial ownership allows you to treat the property as yours for tax purposes.
Okay.
Right, and that's that bare trust I had
So
mentioned.
you just report as if you own.
So it's exactly, so like you're still gonna get the deductions, or the added cost essentially of fixing up the property. The cost, like even when you close on the
That's what
deal,
I'm saying, you technically didn't close on the property.
no, but you will, like, when
Right,
that
so
transaction
when you
happens.
flip it, you never actually close on it.
Even then, you're gonna basically, your margin or your spread that you're making on it, that, and your expenses is essentially your expenses, your income, and then the net is
So
what your
you're
profit is.
declaring them and
Exactly.
this year accepts it as.
Well, you're gonna
you
get-
never owned it, you were the middleman, but you were claiming all those expenses and profits.
Yeah, because what CRA is gonna do is they're gonna say, what were you doing in your business, right? So your business was to go in, you're doing the agreement
And
for
I
sale.
guess you have the paperwork to show. it.
Yeah, you're fixing up the property, so the expenses to fix up the property is a deduction for you.
Yep.
You're selling it for a margin or a profit, that's your income, and then you're basically paying tax on the spread.
Great questions,
To
guys.
get into the lending, private lending side,
Mhm.
on an average, let's say me, I want to get into that lending part.
Mhm.
How much is the average money or cost I need to bring on the table to start having those transactions?
Sure. I recommend for most people to start with about $50,000. Under that, it's difficult to structure deals, and it's actually difficult to get your terms under the APR, the usurious rates. They just lowered it in Canada. It used to be 60% was illegal. Now they lowered it to 35%.
What's the average interest that you can expect?
Yeah. So for first mortgages, if you were to, like, say somebody's going to buy a house here in Calgary and you were going to lend them a first mortgage, if they're paying $500,000 for the house, you're going to lend them $300,000. You'd probably charge somewhere between 8 and 10%. If you're doing a second mortgage, you're probably somewhere between 12 and 15%.
And that interest that I'm earning on that, that's the income.
That's right. Yeah. Now that's the nice benefit of the retirement accounts, of course, is if we're putting it in a TFSA or an RSP type of thing, you can lend and all that money grows tax deferred. Or if it's in a TFSA, then you get to pull that money out and that's tax-free income, which is pretty awesome. So for most of you that are, I don't know, how long have we been doing the TFSA thing now? About 12 years?
Yeah.
So if you've been over 18 for 12 years, so you'd be 30-ish. So anybody that's 30 and over, you've probably got about $110,000 worth of room in your TFSA. So that's a pretty substantial amount to say, I'm going to take whatever capital you've got if you sold the property or have some capital, put it into a TFSA and lend that out at 12%. Now that's $1,000 a month, right? Extra $1,000 a month tax-free it'd be a great way to supplement your income, pay for your mortgage, whatever. So it's a great strategy if anybody is interested in talking about that. Happy to chat about that later.
The nice thing with the TFSA is when you take money out, you can actually replenish it in the next year. That's different than the RSP. RSP, if you take money out, you don't get any more room. But with TFSA, if I go in and I take $10,000 out this year, next calendar year, I have an extra $10,000 that I can put back in. So even if you're using it as an income source and you're saying, okay, you know what, I'm pulling out $1,000 a month for my second mortgages, next year you can then go and get a lump sum money and you can put more money in and keep doing more deals that way.
Love it. Awesome.
Is that the same account that if you haven't put any money into it, you can actually do a one lump sum?
Yeah, at any point in time you can do a lump sum.
Excellent. That's private mortgages, guys. Wanted to, let you know a little bit about what we do. If there's any way that I can help you guys get pointed in the right direction, if you're looking for private capital, if you want to, know how to talk to your friends and family about, hey, I'm doing this real estate thing, I want to, borrow some money and things like that. I'll give you another quick a bit of advice. So when you're raising capital, we talked about this real estate triangle. There's this fun word that people use in the business. They call it the capital stack. You're like, what's your capital stack, right? And a lot of us don't use that every day, and so it's like, oh, I don't know what my capital stack is. The capital stack is your real estate triangle, okay? So it's like, what are you using to buy this property? So are you using a first mortgage? Are you using a second mortgage? Are you using equity, okay? So when we're putting together our capital stack, there's things that you can and can't do. So in Canada and in the US, you can't go out and tell 10 people like, hey, I'm gonna go buy this fourplex and I want, 50 grand from you, 50 grand from you, 50 grand from you, 50 grand from you, and use that as your down payment. That's called issuing a security, and you will get in trouble with the securities people. In the US, you'll get in trouble with the SEC, yeah, and in Alberta, you get in trouble with the ASC. Don't do that. So what's really cool though is that if you're doing your mortgages properly, you can go out and borrow a third mortgage or a really big second mortgage. And I would recommend using a mortgage broker because they're going to help make sure that you're doing this properly and legally. But you can actually borrow 110% of the value as a mortgage, legally, without having to go through all the Alberta securities stuff. So if you guys have ever learned about raising capital, so we went through this exercise a number of years ago, and the regulations continue to change, so I won't try to educate it because I'm probably out of date on it. But basically after the real estate fallout in 2008, tons of investors got burned, and so the Alberta Securities Commission said, we're going to really crack down on what you can and can't do. It used to be that any mortgage broker could take 10 people, each with $100,000, and put a syndicate mortgage together for $1 million, and you could use that $1 million to go and buy a big fourplex or something. And while that was really good for builders and flow of capital and being able to do deals, a lot of scrupulous people decided, well, I'm just going to go and get my license, then I'm going to go and raise a bunch of money, and then I'm going to walk away with a bunch of money, and everybody's going to lose their money, and I'm going to get away scot-free. And so a lot of people lost money, a lot of people were doing things that they shouldn't have, and so the Alberta Securities Commission said, no, we're done with that. So now Alberta mortgage brokers are not able to do syndications. If you want to do a syndication, which is putting more than one person into a loan, you have to get additional qualifications, and you have to be an investment fund manager and all these other things that you have to qualify, and regulations and rules and things about. So one of the simple ways to raise capital is with debt. If you want to try to raise equity, you have to go through this ridiculously horrible process of issuing an offering memorandum. You have to go through an exempt market dealer. You have to do all these things, and the costs are so bad that it just eats away any profit that you would have wanted to give to the investors. Generally, it's very hard to do these deals because the exempt market dealer is going to take 2 to 5%. The lawyer is going to take $20,000 to $40,000 to do up all the paperwork for it. It's a tough deal to do, especially if you're trying to raise anything under $1 million. So if you're getting into creative financing and you want some advice on how to use debt to structure your deals, happy to help out. And there's lots of other resources out there. I always say just start with ChatGPT, and then to get like information, but then if you want strategy, then talk with somebody that knows how to do it and has done it. And that's my little shtick on raising capital. Raising capital in today's market, it's challenging, and in the U.S. it's challenging as well. It's basically the same thing. If you want to raise from investors, generally they either have to be friends and family or they have to be accredited. And then if you're going to use friends and family, you have to launch a 506B and do the same thing, put together a lawyer, do an offering memorandum. And if you're going to do a 506C, you can only present it to accredited investors. You can only bring in accredited investors. The benefit of a 506C, of course, is that you can actually advertise. The other one, you have to just whisper to your friends and family. You can't post about it. You can't let anybody know that you're raising capital. It has to be just people that you know and already know and have a relationship with you. Kind of similar in Canada, but there's a few more rules, and we have a very regulation-heavy country, and one of the wonderful reasons why I love buying in the US.
How would the second mortgage work in case, let's say, you want to buy a property from a corporation? Or maybe first.
So if you have a corporation and you want to use that to purchase a property, very similar process. So basically, there's just one extra step that the lawyers do to verify that you have the assigning authority for the corporation, that the corporation allows you to borrow money. So just checking in the minutes. Generally, most lenders will say, okay, the corporation is the borrower, but we want a personal guarantee from the directors. So, which is very similar to you signing personally for it. So whether it's in a corporation or not, most private lenders want your name on the deal, so that there's some human attached to it that's responsible for it. Does that make sense?
Yeah.
Yeah, cool.
How difficult is it to get the second and third mortgage?
Very difficult.
Very difficult? No?
It depends.
In terms of like the payouts, obviously the first one has the first instrument registered, right? So are they usually comfortable to be on the second
So,
line?
yeah, good question. So second mortgages in Alberta are very common, as long as the loan to value is reasonable. So any private lender. So I'm going to flip the we're going to turn the hat around a little bit. We're going to talk about being a private lender. So now you guys are going to be the private lender. Somebody's coming to you and saying, "I got this amazing deal. Do you want to lend your money?" Right? So this is how you underwrite a deal. This is how you get comfortable with the deal and determine, is this a deal I'm actually comfortable lending on? Because I'll tell you, I have spoken with way too many investors in the U.S. that have got excited about gator lending, transactional lending, making all sorts of money, and they're losing money like crazy. It's insane. So don't do that. Be smart. So same thing. When we look at a deal, we look at it and say, we've got this beautiful asset, right? You're going to go out and you're going to buy this property for $400,000, okay? And you need some money to close on it, right? So you're going to go out and you're going to get in the US, they use a hard money lender, right? A DSCR lender, let's call it. And let's say they're going to give them $300K, okay? We'll move this line up a little bit to make it more. So now we just need $100,000. So the borrower comes to you and says, I got this deal, it's a smoking deal, I'm going to buy it for $400, and I'm going to put $50,000 into it, and it's going to be worth $600K. Right? After, what do we call it?
ARV.
Thank you. ARV is $600K. So you look at that and you say, all right, that's okay. This is in a city that you don't know about, you don't really know the market, you're trusting the person. So the way that I would approach this deal, if this was somebody coming to me, is I would say, all right, Bob, we're going to say Bob's the borrower now. I'll lend you $100,000 if I feel comfortable that no matter what happens with the deal, no matter what happens with you, that I'm still going to get my $100,000 back. I need to be secured somehow. I'm not going to lend somebody 100% loan to value unless I feel secure, okay? So when we lend on what we call a worst case scenario basis. We look at it and we say, if I lend, let's lower the expectations here a little bit. Let's say I'm going to be this private lender now, and I'm going to lend $300,000 on this property, and the borrower, Bob's going to put $100,000 down. That's a much more reasonable deal to get involved in, right? So I'm going to write a check for $300,000. I'm secured in first position, and I'm going to charge him a nice reasonable interest rate of 8%. Okay. Now I look at this deal and I say, okay, Bob, you're going to go in and you're going to fix it up. That's great, and it's going to be worth more later. Wonderful. I'm not there checking on you every day. I'm not there checking to see if your trades are insured. I'm not there making sure that you're actually putting money into the property. I'm not there making sure there's no homeless people sneaking in at night and they're cold and they start a fire to stay warm and they burn the house down. I'm not in charge of any of that. I'm just your lender. I'm sitting back and I'm earning 8%. In order for me to feel comfortable doing that, I need to feel well secured. And so in order to feel well secured, the process that I would go through is I would say, Bob, let's say 2 days after closing, you've gone into the property, you started doing your demolition, right? You're pulling out the cabinets, you're pulling out the old stove and the old bathtub and all these things. Now you've got this house that's just in complete disrepair, which is what you need to do to fix it back up. But then Bob disappears. Bob just gets completely abducted by aliens. We have no idea where Bob went. And so the only reason I know that Bob's not around is because check doesn't come through the next month, right? And so you start calling Bob. You're like, Bob, where's the check? Bob's not answering. You start asking, his friends and family, where's Bob? You call up a couple of the contractors that you knew were going to be working on the deal. And they're like, yeah, we don't know where Bob is. Bob hasn't paid us, and all these different things. So now you've got this problem where now you have this house that's no longer worth $400,000 because you can't resell it. Nobody's going to live in it. You can't. There's nothing there. It's just this shell. And now you have to go through the process of foreclosing on it or taking ownership of it, dealing with the process. And again, depending on which province or state that you're in, there's different rules and timelines around that, and costs. And so there's a loan to value ratio that we use is usually around 75%, where we feel comfortable that we've got this 25% equity buffer that we would say, I feel comfortable that no matter what happens to Bob, I can still, even if the value of the property is here by the time I get it, I can figure out what to do with it, either put some money into it and sell it for what Bob was going to do, or I can just sell it to another fix and flipper for $300,000, get my money back, and move on to the next deal. So that's a lot to take in, because we've just flipped the script completely, and we're like, borrow high and third mortgages and blah, blah, blah. And it's like, no, don't do that. So it's important that you understand that any rational lender is going to have this requirement and conversation and want to know and understand how you're going to pay me back if the worst case scenario happens. And if you've done real estate, you know that bad things happen. Floods happen. I'll tell you a story. We had a fix and flipper, and this guy had the worst luck, and he just wasn't very responsible. So he's renovating this house. He had this great idea where he was going to buy 1,000 square foot bungalows in inner city Calgary, take the roof off, and put a second story on, and then put a roof on, and now you have a 2,000 square foot property, inner city Calgary, and it's basically a brand new house, but you don't have all the costs for new basement, excavation, connecting utilities, right? So really smart idea. He got it gutted, he got the roof off, and then it was like January, just cold. And he didn't tell me about this till like 2 months later. And he's like, yeah, you know that property? He's like, well, it turns out that we forgot to tell the city to turn off the water. And so, there's like the fitting that comes out of the ground and the concrete in the basement, and like that's where the water comes out. Well, that froze, and we got a call from the neighbor that there was water coming out of the windows, the basement windows, flooding onto the yard. And so the entire basement had filled up with 8 feet of water. So obviously there were some drains there, but they were clogged with debris, and so the water just kept going and going and going. He was not able to the city wouldn't allow him to put it into the storm drains, and so he had to pay for a pump truck to come out and suck the entire basement out of water. It was about $4,000 or $5,000 to get the pump. So these are the types of things that happen, right? So if you're going to be the lender on title, you want to make sure that like you're well secured, right? So that's a little bit of flipping the script. So there's a number of things that we can do when we're looking at a deal to say, all right, Bob, you're bringing me this deal. I want to give you as much capital as you need, but I need to feel secured. So the next thing that we would do in this situation, so let's rewind it just a little bit. I want to give you guys a solution instead of just a problem. So let's say, again, he's got this $300K hard money lender, and he's looking for $100,000 to buy this thing. And let's say that he's got the $50K. No, let's not. Let's say he wants to borrow $150,000. So $100 to purchase it, 100 plus 50 to reno. Okay. He's got no money in the deal. So first red flag. It's like, when I'm a lender and any other lender in general, they're always going to say, we want skin in the game. That's the term that they use in the industry. We want to make sure that if things go bad, you're going to feel it. If you're putting $50,000 of your own money into it and things go bad and I get exposed here, you've lost the 50, you're hurting. I want you to hurt before it starts to hurt me, right? So I want that person to have that skin in the game. That's every lender that you talk to, every MIC, every hard money lender, they're going to say the same thing. We want you to have that capital. Now, can we figure out some way to still lend him this money and help him do this deal? So we're a solutions-based lender. So when we look at a problem like this, we start to ask more questions. We say, do you have any other assets? Oh, well, of course, I've got my own primary residence. Great, tell me about your house. Oh, it's in Varsity, it's worth $900,000, and I owe $500,000 on it. All right, with TD. So we look at that and go, well, it turns out that you've got lots of equity in your primary residence. So how about I lend you $150,000 second mortgage, registered on the new property, and behind TD on your primary residence. Now I feel really well secured, so that if Bob died or got abducted by aliens or the project went sideways, I have another asset that I feel very comfortable that I can go after, liquidate the property, and get my money back. So that's just a really simple solution. Sometimes you'll get people, I don't have any other assets. Okay, then we say, well, it sounds like you might need to bring a partner to the table, right? And so that partner may come with capital, or they may have assets that we can use as additional security.
This one, you have the second mortgage on the primary residence, right? And also on this one?
That's right. So this is what we call a blanket mortgage or an inter alia mortgage. So we would register the same mortgage on numerous properties. Sometimes we do as many as 5 or 6 properties.
But it's worth 150.
That's right. And so if this property sold for $900,000, you would pay out TD, and you would also pay out this, and then they'd obviously have the balance in cash. And so it would get discharged off of both properties at the same time.
Okay.
Yeah, good
So
question.
it can be tied to more than one title.
You got it. Yeah. Any questions about blanket mortgages, additional security?
And the mortgage shows up on the title or
On both.
on both.
Yep.
And
Great question.
TD would be fine with that.
Again, so what's interesting, in Canada, at least in Alberta, nobody gets notified when you register something on title. TD won't get notified. They get notified if your insurance changes, and they'll get notified if you're not paying your property taxes. So if you're registering a second mortgage, like I said, no bank lenders ever called a mortgage due because there's a second mortgage. Any other questions about blanket mortgages? Awesome, that was fun, guys. As you can tell, I'm pretty passionate about this stuff. I like talking about it. I could talk about it all day. But yeah, that's the end of the conversation or the presentation for today. So I want to invite you guys to mix and mingle, get to know each other, ask each other.
Are you gonna do this every month?
No, heck no. I am not going to do this every month. So we talked about this just before you came in. So and Mitch, this is all an update for you. Actually, why don't you come up here, Mitch? So Mitch and I are running this. We're co-running this together, and we haven't had a chance to update. I had a good conversation. I presented this to half the people. Everybody else that showed up late didn't get it. Had a really good conversation with a gentleman that's doing this in Edmonton. And so he was saying that their big success has been having 2 to 3 speakers at the events, which attracts a whole bunch of different types of people. So he kind of gave me his layout, and he said, if you're doing this, this is probably the best way. And so what I told people today is I said, this is our meetup. We can make it whatever we want. So if we just want to show up and mix and mingle, we can just show up and mix and mingle. If we want to show up and have something very structured, we can do that. Or if we want to do a hybrid, or we can do, 1 month we do just networking, and then the next month we do some guest speakers, right? Stop. And so yeah, that's the conversation that we're going to be having with each of you. We'll likely be sending out just a bit of a survey. That's probably the simplest way for us to get some feedback from everybody to say, these are kind of the options we're thinking. What are your preferences? We just want to create an opportunity for everybody to grow, to network, to be able to share in resources and understanding. Because we know that if you're part of PACE's community is everything, right? If you've seen what happens in a room where this person is looking for this thing and somebody else across the room has it and they're 10 feet away, but they don't know each other, they don't know, and you start mixing and mingling and you find out that this person needs this, and you go and tell them, and you're like, hey, this guy's looking for this and he's got money and he's doing this, and blah. It's pretty awesome what can happen very quickly. So that's the whole idea behind these meetups. And I'd love for Mitch to just share with you guys a little bit about what he's doing, because he's doing some crazy fun stuff.
So I live in Canada, but I don't do any business here anymore. So my background is in new construction. I started that back in 2007. But ever since meeting people like Steven and learning about creative financing and mortgages, I now completely am based out of the US and doing large scale developments. So we have everything under contract right now, from small subdivisions to 2.5 acre plots that we're developing with partners. And to his point, I never thought any of that would be possible except for getting into rooms like this and networking. Everything that I have grown into in the last year is because of I got to meet people and talk to people, and that very thing of, hey, Steven, I'm looking for this. Like, he and I were talking about a deal the other day, and Steven's like, I probably can't help you because I'm too busy. He was like, awesome. But then I talked to somebody else who was like, hey, that's actually the person you need to talk to. And now I've talked to them and the deal will likely go ahead. And it's just by networking and chatting. So I 100% am of the same pace, or on the same page of I'd love to get together once a month and sometimes just network. Or you let us know what you want to hear about and what you want to learn about, and between us and some of the other people in this room, we have a large enough network to make that happen. So whatever it is you want to learn about or have questions about, between us, we could probably figure that out and make it happen, because that's the only way we grow is together.
Awesome. Love it. Any questions? Any comments?
Do you guys have like a Facebook group we can follow?
No, not yet. That's a good idea, though. We've been trying to figure out the best way to do that. And so I've been, again, asking this other gentleman that's running this in Edmonton all these different questions. So there's a few things that you'll likely see. We're recording the event, which is something that I hadn't thought of doing before. He's like, definitely record the event. Make sure that people see it. Put it on your socials. And obviously, we want you guys to share these things as well. So we'll tag it somehow, and either, I don't know, Louise, what's the best way for us to make sure that they're seeing these things? And I guess we'll put it in the emails or in the Eventbrite somewhere so that you guys can get on there, click on the links, download some of them, share them on your socials, and get more people here. Because I think, again, the better quality people that we have here, the more people that have different backgrounds and knowledge and expertise is just going to make it better for everybody. Hey, Suvik. How you doing, brother? There's guys like this guy that you got to meet. So if you haven't met Suvik, make sure you come and chat with Suvik. So there's some real players in the room, and like I said, you wouldn't know if you don't ask. And some people are very private about what they're doing, their lives, and so make sure that you're getting to know people, digging deep into what they're doing, what they're trying to do. I'll give you some of the tips that Pace generally talks about when he talks about networking. I hate networking. I'm kind of introverted. I hate being up here, just so you know. But so networking for me is just like, right? It's like, I got to go and like talk to people and interrupt them and be awkward and stuff like that. So what if we're all good? We're just going to allow everybody tonight to just be awkward, be themselves, come in and interrupt and introduce themselves. And basically the questions that you want to ask is not, oh, the weather's great, huh? Right? Get really intentional about what it is you're trying to do here, right? So if you are looking for capital, share with people that you're looking for capital. So the things that you want to ask are, what do you do and what are you looking for? And ideally, if that person's reciprocal after they've shared with you, they'll likely ask you the same question. And if you can, have those conversations with 3, 5, 7 people tonight, guess what? You're going to learn and understand a whole bunch about what these people are looking for, and you're probably going to go, oh, you need to go talk to Suvik. You need to go talk to Mitch. I just talked to that guy. He is smart. He knows what he's doing.
I just wanted to say congrats, by the way.
Thank you.
Don't strike me as an introvert at all. I'll give him a round.
Thank you.
Just was in Arizona and networking events like crazy, just all jacked up. One of the things that I found as somebody who's new to this industry, I understood what my value I could bring to somebody was, and I understood what my goals were, like you were saying. And so I just led with that. I wanted to know what I could bring to people, and then they asked, what are you looking for? And it was just so much easier to actually get to the heart of the conversation that was of value to both parties, as opposed to just like, oh, what do you think of today's event? Like, all the stuff that really doesn't matter. It's like,
Right.
I want a speed date right now, but I want to be respectful to you
Yeah.
as well.
And so we can, in addition to all the things that we talked about, we could also do some events like that where we do some sort of networking, speed dating, right? So we can get to know as many people and add value to as many people as we can. There's lots of fun things that we can do. So we'll put out some questionnaires. We'll get a better sense of what you guys are looking for. And we'll probably be reaching out because, again, the community is the community, right? So each of you is going to have some connection, some contact. We're going to outgrow this venue very quickly. So we're going to be looking for another place. So dig into your network, your knowledge, and go, oh, actually, I know of somebody that's got. The guys in Edmonton, they said that for 18 months, they actually had ATB agree to allow them to use their bank as their space. And so, the options are endless, right, of where we could host this thing. We may get away with doing it one more time here, but likely, and just so you know, I was chatting with Pace the other day. He's like, hey, I've missed 2 stops so far on the Creative Nation tour. I'm definitely going back to Boston and to Calgary. So he's trying to set a date from sometime in July, and so that'll be super exciting. We'll have to get a much bigger venue for that one as well. So
For Stampede is what he said.
I told him, like, Pace, you should come for Stampede. He's like, and he said he's like, isn't that where all the girls are running around topless? I was like, is that what people think of Stampede? Yeah. So anyway, that's good. Awesome, guys. Well, I'll leave it up to you to mix and mingle. Stick around as long as you want, and then yeah, hopefully you guys get a chance to meet everybody and add some value. So
Thanks a lot.
thank you. Thanks, guys.